Hi everybody, Thomas here. Today we're going to take a look at Pepsico, one of the largest beverage and snack companies in the world. This is a stock that's been under pressure until the last couple of weeks. It's been picking up some momentum to the bullish side. Looks like a good opportunity to ask the question of whether or not Pepsico looks like our proverbial sucker's bet or possibly could be a good buy. Let's go ahead and dive straight in. Our chart for Pepsico shows a very nice upward long-term trend, as we can see with our 200-week moving average. Stock has been rallying for a number of years now, from about $100 before the pandemic in 2019 all the way to its peak at around $200 at the beginning of the year. Now, it has dropped back off of that level since that peak. It found a bottom last month down at around $160 per share. However, it has been picking up bullish momentum from that point, and we see that it's been rallying pretty strongly off of that low to its current price at around $167 just over the past 3 weeks. The 20-week moving average is following the direction of the stock's decline off of that peak at around $200 since the beginning of the year. So we do see that moving a little bit down. Now, under ideal circumstances where the stock is bouncing off of the 200-week moving average, that looks like what could be an interesting bullish level one kind of a setup at least a few weeks ago when we had a bearish hammer appear right around the 200-week moving average, with the stock really rallying off of that in the last couple of weeks to confirm that signal. Under ideal circumstances for a bullish level one signal, the 20-week moving average should be starting to flatten out, which it isn't doing in this case. We do see that it is actually continuing to move down, but the stock's momentum over the past 3 weeks does still look like it is giving the stock some momentum up to about $175, which is where the 20-week moving average is right now. So that looks like it could be an interesting opportunity to buy within the longer overall upward trend and hopefully take advantage of a bounce back up to the upside. Now, does that mean that the stock is a good buy? Does it mean that the timing is right now? And do the company's fundamentals support the idea that the stock's price should actually be more right now than it is? Let's dive into our fundamental numbers. Pepsi is a company, not too surprisingly, with a very strong fundamental profile. We can see that over the last 12 months, free cash flow has been pretty healthy and increasing from about $5.8 billion to its current level at about $7.1 billion. That's a very strong amount of growth. Also, most of that growth has really just happened in the last quarter, when it increased from about $5.9 billion to the current level at $7.1 billion. The company's liquidity has also been improving throughout the course of the last year, from about $5.3 billion 12 months ago to almost $10.3 billion in the last quarter, and also from about $6.4 billion in the quarter prior to that $2.3 billion level. So cash has been increasing, liquidity is improving. That's generally a positive mark. Long-term debt looks to be generally manageable at about $35 billion right now, just a little under $36 billion right now. That is pretty much level with the last 12 months and a little bit lower over the past 3 quarters, which I do take as a generally positive sign. Another strength comes from the company's overall operating metrics, which for me rely primarily on net income versus revenue. We can see that on a trailing 12-month basis, that number was about 9.05% and increased in the last quarter to just a little bit over 13%. So we see a very positive increase over that period. That implies that the company's operating profits are improving, and that confirms the overall increasing pattern of free cash flow and liquidity. It implies that the company's overall balance sheet remains pretty solid and healthy. This is a stock that pays a dividend of $5.06 per share. That sounds pretty interesting if you think about it just in terms of the total per share amount. When you compare it against the current price of the stock, it's still pretty attractive at just a little over 3%. That's a little bit below what you can get with some higher paying dividend stocks as well as from current bonds. But still, when you're talking about thinking about a stock as a potential long-term investment on a value-driven basis, being able to get a passive dividend income yield of about 3% is not too bad. Now, in terms of its overall value proposition, despite all the fundamental strengths that we just talked about, the truth is that even with the stock's decline since the beginning of the year from that peak at around $200, the stock still hasn't dropped far enough to represent a useful value. My metrics put a fair value target at around $166.64, which is right about where the stock's price is now. That means that if I'm looking for a value-driven opportunity, I should really wait until I see the stock approach the level at around $133 per share. It means that right now this is a stock that is really only fairly valued. And that doesn't completely dismiss the technical signal, which we're going to take another look at here in just a moment, but it does beg the question, if you're thinking about Pepsi as a long-term investment, whether or not that price is good enough to warrant taking on a potentially long-term position. If you've gotten to this point and you're thinking that Pepsi might look good enough to go ahead and try to take advantage of this latest upward swing in bullish momentum, then the natural question should be to start thinking about what that technical setup looks like in terms of reward to risk. Is there enough upside opportunity compared to whatever potential downside there could be if the stock suddenly were to reverse direction? We can see current support for the stock. I'm going to put it back here at around this $160 level. Remember, the stock is right here at around $167. So that means that there's about $7 of downside right now to that current support level. I put immediate resistance not too far from the stock's current price. If we use the declining 20-week moving average as a primary indication of where the stock's most likely immediate resistance is going to be, then that would put it at right around $175 per share. And that's about $8 away from the stock's current price. That means that in terms of reward to risk for the stock, we're looking at about $8 of upside against about $7 of downside. In other words, reward to risk is just about 1-to-1. If you're thinking about a short-term based trade on a stock like Pepsi, you should be looking for reward to risk of at least 2-to-1, if not better. That means that even with the stock's current bullish momentum, its reward to risk opportunity isn't good enough to justify taking any kind of a near-term trade. Considering the fact that the stock's value proposition is also not good enough to warrant a long-term investment, that can only mean that Pepsi is a sucker's bet. Thanks everybody for your time. If you've found this video to be useful, go ahead and subscribe to my channel, which you can do right here. If you'd like to learn more about how I analyze stocks and the Rebel income system that I like to use, you can go ahead and click on this video to learn more about my system. If you'd like to see my trades, you can subscribe to my trading alerts using the link that you can see in the description for this video. Thanks again everybody for your time. I'm Thomas with Rebel Income. See you again soon.